let's move on then. Kapish Jain, CFO at IIFL Finance, joins in to talk a little bit more about the quarterly performance. And Kapish, your loan growth has been healthy. NIIs as well have been strong. So what has really aided this NII growth?
So, given that we operate multiple businesses and each businesses have their own share of NIMs, we have gone into high yield businesses like microfinance. We've also repriced our assets on the housing finance book as well, both in the housing and the lab book, which is not just passing on the overall rate hike as well, but right pricing our assets. We've also expanded on the digital loans piece as well, which gives you higher yield. Each of them is aggregating to an overall portfolio yield, which is enabling a higher NII as well. Our disbursements actually on a YOY basis grew by around 46%. When you disburse, you actually then also get your share of fee income, processing fees, other items as well with the volume growth, which also adds up to your overall NII. So NII is not just a factor of the volume growth, it's also a factor of other revenue lines that comes along with it, which is causing the expansion in the NII being more than the overall book growth.
Okay, hi, this is Anisha also joining into the conversation. What's your outlook with respect to credit growth in FY24? We were just talking to the management of Canfin Homes as well. They were talking about some moderation. What's your expectation?
So, as we have always mentioned, consistency is key for us. We have categorically mentioned that we're going to grow in our core segments, not in any order, but it would be the housing business, the lab business, the microfinance business, the gold business, and the digital loan space, which is gaining a lot of momentum. So these are the core segments in which we're going to focus and grow. And with that, we see that there's a lot of momentum across. Microfinance possibly is in its best space with all the regulations aligned with right pricing the asset. And there's a huge demand there as well. Gold, you would know, is a very, very sweet spot where the pricing is really very stable, and that makes the segment to also grow with a huge unorganized segment existing for the growth opportunity. Housing, you would know, is a huge untapped market. Aggregating all of them, there's a huge opportunity for growth, and we're going to tap the market. We have expanded a lot. We've added close to around I would say, close to around 20% more branches last fiscal, which is going to give you the opportunity to grow because these branches needs to be monetized. So the outlook for growth is fairly positive. We're going to grow and make it a very a controlled growth environment. We will make sure that we are not diluting any of our credit norms. And with that, get the growth engine going. We have grown on a CAGR of around 25-26%. Pure retail, we have grown at 23% CAGR in the last 5 years. I don't think that we will not be able to maintain that in the foreseeable future, at least for the retail businesses where we operate.
So is it fair to assume that you'll be targeting a 25 to 30% loan growth in FY24?
I wouldn't say 25 to 30%. I would say that we have been at around 23% CAGR. And with the build-up that we have done, with the expansions that we have done, we would like to see that we grow at the similar trend. And it could vary from business to business, depending on what opportunity business brings us to us. But we should be gaining to a similar kind of a growth range, be it 20%, 25%, something around that.
Okay, the home loans as well as gold loans account for the majority of your AUM, and competitive intensity in both these segments has been quite high. Given that context, what's your outlook when it comes to yields as well as the competitive intensity?
So, competition has always been there. You cannot just operate without competition. You need to create your own niche. You need to make sure that you have your own customer base, which is loyal to you, and they are sticking to you through your customer service experience as well. So gold business is a game of loyalty. Gold business is about sustaining that customer for long because he's giving his own personal gold possession, which is more about his own family wealth and a family's asset. So there we have grown and expanded and gone beyond tier 2, tier 3 cities. We're going to tier 3, 3 or 4 cities. As you go deeper into the country, your competition goes down. It tapers significantly. And then you can create your own green shoe and expand yourself. We have demonstrated in the last few years that possibly as an outlier that we are one of the few gold finance companies who have grown and grown well. And we think that we will be able to sustain that. There's still 65% of unorganized market which is operating in the entire country. This is a huge market opportunity available. So leveraging that opportunity, leveraging our own relationship and loyalty and the built-up of branches that we have done, we think we'll be able to sustain the competition and be able to grow with a reasonable amount of spread and NIM that we have maintained in the past.
Now, microfinance as a segment as well has been picking up pace in the industry after favorable regulations. Your microfinance AUM as well has gone up by 59% year on year. How meaningful could this segment be going forward, and what is your view on asset quality?
Microfinance has been a very it's like a pepped up demand which came post COVID. Microfinance has been a subdued segment for a while because of all the, like what you rightly mentioned, because of all the regulatory issues that the sectors faced. More particularly, if you are more efficient, you cannot price more to the customer. To give you an example, earlier the regulation mentioned that you cannot charge more than 10% of your cost of borrowing, which means if I'm more efficient on my cost of borrowing, my charge to the customer would be lesser. That dichotomy has been removed, which means that you right price your asset. A microfinance as a segment is very price inelastic segment. You need to make sure that you choose your customer right, you expanded your base, and asset quality is paramount. It is something that you can't compromise. And more importantly, there could be cyclical segments there could be cycles here which can come in, but you make sure that your balance sheet is well covered through your provisions. With those elements, we believe that we should be able to expand and grow. We've added a lot of branches there as well. And we should be able to grow by leveraging our balance sheet. We have moved towards co-lending and microfinance along with some of the others, and co-lending and more particularly direct assignment in microfinance as well. It's 100% priority sector assets. If you're providing good, pristine assets to banks, they are happy to take it from you and buy them from you without any risk reward sharing, except for the sharing of the asset percentage that you're given to them. So we're going to build ourselves in the microfinance. We'll go asset light, just like we have gone in some of the other businesses, so that we are right pricing our risk and taking the right share of the risk as well in the balance sheet, and have a very good hold on our asset quality.
Okay, let's talk about recoveries as well, because if you could tell us how has the recovery been for the company so far, and what's the expected credit cost when it comes to incremental book?
So we want to make sure that the basics are maintained, the hygiene is taken care of, which is more particularly the risk management element, the recovery and the collection part. You would have seen that our asset qualities have shown improvements. We've seen that the market is also is behaving well. The propensity for payments and collections and recoveries are also quite healthy. On those lines, our asset quality has improved. Our gross NPA is now touching at around 1.84 at overall portfolio level, and the net NPA is around 1.08, which is in line or maybe a little shade better than the guidance that we have given to the market. With that kind of guidance, we would be able to maintain and even improve on those levels, because that would be our focus. And that happens only when you are making sure that you are sourcing the right customer and having the right credit check of those customers. With the right sourcing, the right credit check, most of your problems are getting resolved on day one. And then have a good tap on your early delinquencies and early bounces, which comes in. With those basic hygiene, we should be able to make sure that we are keeping good asset quality. We always have a very close check on how the book is performing on a regular basis, and that frequency is fairly high. And at those frequencies, we see how things are moving, and basis that, if we see any concerns, either we change our strategy on the product, or we try to go slow and hold it back to see how it moves going forward as well. And we think with those kinds of checks and measures, we should be able to keep it well. Our guidance on credit cost has been at around 1.5, and we think we should be able to maintain that credit cost guidance going forward as well.
All right, thank you for joining us and giving us that view on the financials. With